Silver is sitting under $65 like it's hitting an invisible ceiling, and that's not technicals. In the next 72 hours, one hidden options buildup can trigger a chain reaction that either pins silver in place or turns the market unstable fast. Watch what happens at that strike. Silver is not trading like a normal commodity anymore, and if you're still trying to understand this market using the old playbook, mine supply, jewelry demand, inflation, interest rates, you're going to miss what's actually moving price right now. Because the next move may not start in a refinery, a mine, or a vault. It may start inside the options market, and specifically it may start at one number, $65. Right now, the silver market is sitting in a very specific kind of trap. Not a chart pattern, not a sentiment shift, a mechanical trap, a positioning trap, a gamma trap. Here's the problem in plain English. There is a massive concentration of options contracts stacked around the $65 strike, and the institutions that make markets, dealers, market makers, the bullion bank desks that warehouse risk, have one primary objective into expiry. Keep silver from cleanly breaking through that level. Not because $65 is magical, but because $65 is where their hedging becomes a chain reaction. The number attached to this setup is not small. Across the complex, silver-linked options tied to futures pricing in the major derivative venues, there are roughly 280,000 contracts clustered in the $60 to $70 zone, with the heaviest gravity right around $65. And when you have that much open interest stacked at one strike, price stops being discovered. Price becomes managed, because if you're short calls as a dealer, you do not want the market to run through your strike into expiry. If it does, you're not just wrong, you're forced to chase. And in this market, forced chasing is exactly how melt-ups are born. Now let's slow down and define the battlefield, because this is where most people get lost. When you hear options, most retail minds go straight to gambling, calls, puts, lottery tickets, whatever. But at the institutional level, options are not a sideshow. Options are a control surface. They are a lever. A huge percentage of short-term price behavior in modern markets comes down to how dealers hedge the exposure they've sold. If a dealer sells you a call option, that dealer is short the call. That means as price rises, the dealer's risk increases. So the dealer hedges by buying the underlying exposure, often futures, sometimes other derivatives, so that if price rises, their hedge gains offset the call's loss. That hedging behavior is not discretionary when things get tight. It becomes automatic, and the key word that determines whether the hedging is calm or violent is gamma. Delta tells you how much an option behaves like the underlying. Gamma tells you how fast that delta changes as price moves. Near a major strike, especially near expiry, gamma gets extreme. That means a small move in price forces a large change in hedging. This is why the phrase gamma squeeze exists in the first place. It's not a vibe. It's a mechanical feedback loop. Here's the simplest way to visualize it. If silver is at $63, a dealer who is short a wall of $65 calls might be only lightly hedged, because those calls are still out of the money. Their delta is smaller. But if silver moves from 63 to 64.50, the delta rises quickly. And when silver tags $65, the delta of those calls starts racing toward 1. Meaning, every contract starts behaving more and more like the dealer is short actual silver exposure. So what does the dealer do? They buy. They buy futures. They buy exposure. They hedge. Not because they want to, because they must. And if the market is thin, and right now liquidity in silver is thin in the exact moments that matter, especially after hours and into Globex, those dealer hedges can become the very buying pressure that pushes price higher, which forces more hedging, which pushes price higher. That's the loop. And once you understand that loop, you start to see why certain price levels act like invisible ceilings for days, even when the fundamentals are screaming higher. Because someone is leaning on it, and they're leaning on it for a reason. Now here's where the 72 hours matters. We are walking into a short-dated expiry window. The kind of window where time disappears, gamma explodes, and the market can go from controlled to uncontrolled in one session. If the main expiry is this Friday, then the game is played right now, Wednesday, Thursday, and the first half of Friday. This is the countdown phase. And the cartel's preferred outcome in a countdown phase is always the same: pin the price. Pinning means keeping price near a level that inflicts the most pain on option buyers and minimizes dealer payout. This is where max pain comes in. Max pain is not a conspiracy theory term. It's a concept options desks actually model. It's basically the price level where the largest number of options expire worthless and where the least amount of money is paid out to option holders. And in this current setup, max pain is clustering just under $65. That tells you something important. It tells you the market is magnetized to that number, until it isn't. Because there are two regimes. Regime 1, price is below the call wall, dealers are short gamma, and they can manage it by leaning on price, selling into rallies, pushing it down during thin liquidity windows, and letting time decay do the rest. Regime 2, price breaks above the call wall with momentum, the delta flips fast, the hedge requirement spikes, and now the same dealers who were selling to cap it become forced buyers trying not to blow out their books. That's when it turns from a pin into a rip, from suppression into acceleration. And the most dangerous part for them is that once the hedging starts, it can happen faster than their ability to manage the tape. Because hedging is not an opinion, it's math. Now look at what the market is already whispering. Implied volatility has jumped. Not gradually, jumped. When IV spikes into expiry, it's the market admitting uncertainty about range. It's the market admitting the probability of a violent move is rising. In setups like this, you often see implied volatility climb from the high 30s into the 50s and 60s annualized in a matter of sessions. That doesn't happen because everyone is calm. It happens because positioning is crowded and liquidity is fragile. And liquidity is the silent killer here. Silver is not the S&P 500. It's not an infinite depth market where you can absorb forced buying without a price gap. Silver's order book can go air pocket thin, especially at night, especially in Asia to Europe handoffs, especially when everyone is watching one level. Which means if the price starts to lift through $65 during one of those thin windows, the market can move a full dollar before anyone decides anything. And that is exactly why you see the weird behavior we've all seen for years. The timed hits, the sudden sell walls, the normal price action during the day, and then the strange movement when liquidity is lowest. This is also why Friday nights matter. Because the most effective time to enforce a narrative is when the audience is asleep and the liquidity is gone. If you want to smash a market into expiry, you don't do it when the world is fully awake and bids are thick. You do it when the market is quiet. You do it when stops are clustered. You do it when the margin desk can change rules, when headlines can be timed, when the opening print can be shaped before most participants even log in. And Monday openings matter too, because that's when the public re-enters the market after the invisible work has been done. That's the rhythm. Pressure into expiry, manage the strike, reset positioning, repeat. But here's the problem for them. Silver is not the same silver market it was even 6 months ago. At $60 to $65, silver is now a headline metal. It's now a strategic metal. It's now a metal with industrial urgency attached to it. And that changes behavior around these strikes. Because in a normal environment, a smash into expiry shakes out weak longs and kills call buyers. But in a tight, emotional, late cycle environment, a smash is read as a discount. And if physical demand and strategic demand are already pulling at the edges of this market, then a paper-driven pin can become unstable. You can hold the beach ball underwater until your arms get tired. So the problem I want you to see is this. This is no longer just bulls versus bears. This is not even just retail versus institutions. This is now a time-based mechanical standoff between a price level and the hedging engine that sits behind that level. They want $65 to hold because if it holds into expiry, time decay does the dirty work for them. But if $65 breaks cleanly with follow-through, then the very act of hedging can turn into an accelerant. And in a market with thin liquidity, accelerants don't produce gentle moves. They produce melt-ups. Fast, ugly. And once it starts, it's not about should silver be higher. It's about how quickly do they have to buy to survive. So over the next 72 hours, you don't just watch the price. You watch how the market behaves around $65. Does it reject the level instantly with heavy selling the moment it touches it? Does it hover just under it like there's a lid? Does it spike through and get slammed back below in minutes? Or does it break through, hold, and start grinding higher in a way that feels unnatural? Because that grind is often the first sign that hedging has begun. Not a retail FOMO wave, a dealer hedging wave. And that is a very different animal. In the next part, I'm going to walk you through the exact mechanics of how the hedging cascade works step by step, what dealer gamma actually means at the strike, why max pain can flip into max panic, and the specific signals you watch to know whether a melt-up is igniting or whether they successfully smashed it into expiry again. Here's the mechanical sequence you need to understand, because once you see it, you'll never look at random silver volatility the same way again. An options contract on silver futures typically controls exposure to 5,000 ounces per contract. So when you hear a number like 280,000 contracts clustered into a tight range, you're not talking about a small side bet. You're talking about potential notional exposure of 1.4 billion ounces. Now, no, 1.4 billion ounces is not going to be delivered because that's not how options work. Most expire, get closed, or get cash settled through the system. But the hedging is real. The hedging happens in the underlying market, in real time, in size, and it can overwhelm liquidity long before anyone ever exercises anything. That's the key. The options don't have to be exercised to move price. They just have to exist in concentration, close to expiry, near a strike where delta accelerates. That is the heart of a gamma trap. So let's model what happens around $65 specifically. When price is below $60 and dealers are net short calls at $65, they are typically short gamma. Short gamma means the market moves against them faster than their hedge can keep up. If price rises toward the strike, they have to buy more to hedge. If price falls away from the strike, they can sell hedges. This creates a pinning behavior where the market is nudged back toward a zone that reduces dealer risk and maximizes time decay. That's why you'll often see silver grind, stall, and do these bizarre half-dollar reversals with no macro headline attached. It's not always news. Sometimes it's positioning. But the moment that pin breaks, meaning price pushes through $65 and holds, dealers have a different problem. Because calls that were out of the money become at the money, then in the money, and delta starts moving toward 1. Gamma spikes hardest right at that transition point, which means the hedging requirement is not linear. It's not buy a little, it's buy faster as the market rises. And this is where the melt-up risk becomes very real in a 72-hour window, because the closer you get to expiry, the more violent gamma becomes. On Monday, an option might have a moderate gamma profile. By Thursday afternoon, that same option can behave like a landmine. So the setup into this Friday, let's put a concrete date on it. January 9th, 2026 is this. They need the market under control into the close. They need silver below the call wall. They need retail call buyers to bleed out through time decay. They need implied volatility to cool, not spike. They need liquidity to stay thick enough that they can cap rallies without triggering a chain reaction. But here's what's going wrong for them. Implied volatility is not cooling. It's rising. Open interest is not dispersed. It's concentrated. Liquidity is not thick. It's thin in the exact hours where price can gap. And perhaps most importantly, silver is already trading near the strike. This isn't a setup where price is far away and might get there. We're already living on the edge of the zone. So now let's get practical. What are the signals that tell you which regime we're in? Signal number 1. How price behaves on the first clean touch of $65. If silver tags $65 and immediately gets slammed down 70 cents to 120 in minutes, that's not normal profit taking. That's someone defending the strike aggressively, using thin liquidity, trying to reassert the pin. Signal number 2. Whether the rejection sticks. A true defense is not one slam. A true defense is follow-through. If the market is slammed off $65 and then spends the next hours heavy, drifting lower, that tells you sellers still have control and dealer hedging has not flipped. But if silver gets slammed off $65 and then climbs right back within the same session, especially if it holds higher lows, that's danger. That suggests the cap is weakening, because the more times a strike is tested, the more hedging friction builds. The defense gets more expensive, and the moment it fails, the unwind is violent. Signal number 3. the grind higher pattern. A melt-up often doesn't begin with fireworks. It begins with something that feels almost boring. Price quietly refusing to go down. Silver sits at $64.20, then $64.40, then $64.55, then $64.70. Small steps, but under the surface, those small steps are forcing incremental hedging, and incremental hedging becomes cumulative pressure, and cumulative pressure in a thin market becomes a gap. Signal number 4, implied volatility jumping while price is stable. This is huge. If price isn't moving much, but IV is climbing into expiry, the options market is telling you someone is paying up for convexity. Translation: smart money is positioning for a violent move, even if the tape looks calm. Signal number 5, the timing of the hits. If the heaviest selling appears during low liquidity windows, late night, early morning, pre-open, then you're not watching natural two-sided trade. You're watching strategic price management, and you should expect the most aggressive attempt to smash it into expiry, not when it's easiest to defend, but when it's easiest to move the tape. That's why Friday night moves matter. That's why Sunday open matters. That's why Monday morning often comes with a story attached after the fact. Now let's connect the dots into the narrative that fits everything we've already seen in modern markets. If the cartel can keep silver under $65 into Friday's expiry, they get 3 wins. 1. Call options decay into nothing. Premiums die. Retail loses interest. 2. The price action looks contained, which discourages momentum traders. 3. Dealers can unwind hedges calmly, selling into the market without causing a spike. But if silver breaks $65 and holds, especially if it breaks in a thin window where liquidity can't absorb the hedging, then the game flips, because now dealers are buying into strength to hedge. And here's the psychological twist most people miss. The moment the market senses dealers are trapped, other participants join the move, not because they love silver, because they smell forced buying. That's when it goes from a mechanical squeeze to a self-fulfilling momentum event. And it's why these moves can happen in 24 to 72 hours. The time compression is built in, expiry is a deadline, gamma is a deadline amplifier. Now I want to be clear about something because this is where people get hurt. A gamma trap cuts both ways. If price cannot break the strike and dealers are short gamma, the same hedging mechanics can amplify a drop. When price falls away from the strike, dealers can sell hedges, which adds pressure, which pushes price lower, which allows more hedge selling. That's why you can see those sudden air pocket drops that feel like a trap door. So the question isn't, is a melt-up guaranteed? No. The question is, are we at a level where the next move can become self-reinforcing? And the answer, with $65 overhead and expiry approaching, is yes. This is a high-energy setup. So here's the verdict, and it's simple. In the next 72 hours, the real battlefield is not a headline. It's a strike. If $65 holds, expect frustration, chop, and engineered volatility designed to exhaust the public. If $65 breaks and holds, watch for a melt-up driven by dealer hedging, fast, mechanical, and potentially disorderly. And you'll know it's hedging driven when it doesn't behave like normal FOMO. Normal FOMO is emotional and spiky. Dealer hedging is relentless and persistent. It looks like the market is being pulled upward by a winch. So what do you do with this? You stop worshiping the spot price as if it's truth. You watch the structure. You watch where open interest is stacked. You watch implied volatility. You watch the time windows where liquidity is thin. And you watch the behavior at $65 like it's a countdown clock, because in a gamma trap it is. And if you're holding physical silver, understand something. Paper fireworks can change the entire pricing environment quickly. Not because your coin magically becomes different, but because when the paper market gaps, the real-world pricing mechanism adjusts. Premiums, availability, dealer spreads, all of it. The window in these environments doesn't close with a headline. It closes with a gap. Now I want to hear from you. Do you think they successfully pinned silver under $65 into January 9th? Or do you think the hedging engine flips and forces a melt-up before the close? Drop your answer in the comments. Pin or melt-up, and tell me what price level you're watching as confirmation. And if you want more breakdowns like this, where we're not just reacting to the price, we're dissecting the mechanism behind the price, subscribe and stay close. Because into expiry, the market doesn't need permission to move. It only needs one thing, a break above the strike.